Whether you're buying, selling, or renting a property, taxes can have a big impact on your investment. Today, we're speaking with Alzaan Skuman and Carla Buerta from C2M Chartered Accountants to break down the effect of taxes on property investments. When it comes to property ownership, tax plays a big role. What are the key taxes that affect property ownership?
So in South Africa, property ownership comes with several tax responsibilities. The common ones are transfer duty. That's the tax that's payable when you buy a property, unless VAT applies. The good news is that if a property's value is 1.1 million rand or less, there's no transfer duty payable. Any properties with a value over 1.1 million rand, it pays the tax on a sliding scale. Next one is value added tax, or VAT. This is applicable when you buy property from a VAT registered seller. So typically this will be for commercial property or if you buy from a property developer. So when VAT is applicable, there is no transfer duty. VAT can also be applicable if you're renting commercial property. So the next one is capital gains tax. So where you sell the property and make a profit on it, then capital gains tax applies. The next one is income tax on rental income. So all rental income needs to be declared to SARS, and there's certain expenses that can be deducted from that. And the last one is estate duty. Always keep in mind that if you die, that your property can form part of your estate and certain taxes will be applicable there.
Alzaan, I want to expand a bit more on capital gains tax. That's always the big tax that property owners are worried about. Can you just explain how capital gains tax works and how people can minimize their capital gains tax?
It applies when you sell your property, where your proceeds received for the property is larger than your base cost. Base cost is usually calculated by using your purchase price plus any capitalized costs. For instance, improvements that you made on the property. For individuals, the inclusion rate for capital gains will be 40%. Which forms part of their taxable income. In companies, the inclusion rate will be 80%, and for trust, 80% as well.
So, Carla, some people purchase property in their personal name, some purchase it in a trust, some purchase it in a company. Now, I know structuring does affect the taxes that are being paid. How can you structure a property purchase better for tax efficiency?
So there's various ways to structure your property ownership, and whichever way you choose will have a big impact on the taxes that are going to be payable. So the first one is owning a property in your personal name. So that's common for residential property. You could benefit from the 2 million rand capital gains tax primary residence exclusion, but the income tax rate for individuals is at the individual tax rates, which could go as high as 45%. The next one is joint ownership, which can help split the tax liabilities amongst multiple owners. The next one is buying a property through a company. A company pays 27% corporate tax on the rental income, which may seem lower than the individual tax rates. You always need to remember that the capital gains tax inclusion rate is 80%, which is higher than the individuals. Then the last one is using a trust. A trust is a very useful estate planning tool, but the taxes are very high. So 45% income tax rate, as well as an 80% capital gains tax inclusion rate. If the structuring is done properly, the rental income can be distributed to the beneficiaries, which may pay income tax at a lower rate. We would typically look at a client's financial position before advising them, but owning multiple properties in a company or a trust may be beneficial for them.
Let's talk rental properties. What implications should landlords consider when they're looking at their rental income?
SARS expects you to declare all your rental income. However, you can deduct any expenses relating directly to your rental income. Individuals should note that should their taxable income or rental income reaches certain threshold, they might be obliged to register for provisional tax.
So, Carla, many property owners aren't really sure what expenses they can deduct. Can you run me through a few expenses that property owners can deduct from their taxable income?
SARS allows you to deduct certain expenses from your taxable income. So these include bond interest on your mortgage repayment every month. So that's only the interest portion. Rates, taxes, levies, security, any legal fees relating to your property, repairs and maintenance, and any property agents' commissions. It's always important to keep accurate records of all of these, as SARS may disallow if you don't have the actual supporting documents.
So, Alzon, there's often confusion between transfer duty and VAT. Can you break down the difference between the two and when they apply when it comes to property purchases?
So when you purchase a property from a non-VAT vendor or an individual that usually is a non-VAT vendor, transfer duty will apply to the transaction itself. When you purchase a property from a seller that would be either a VAT vendor or someone that used to use the property for taxable supplies, that will apply to the transaction. Individuals that intend to use the property for taxable supplies, where they rent out commercial property, should note that if they purchase the property from a non-VAT vendor, it's deemed to be a second-hand good and they can claim a no-shill VAT. Transfer duty will still apply to the transaction itself, but they would be able, as an input VAT, claim the no-shill VAT.
Carla, South Africa attracts a lot of foreign investors. What should foreign investors take into consideration when purchasing property in South Africa?
So foreigners can buy property in South Africa. They always just need to keep in mind that they will also pay transfer duty or VAT if they buy a property. Any rental income on the property that's rented out is taxable in South Africa. Capital gains tax applies. And then there's a certain part that should be withheld before the money can be transferred out of the country. And then foreigners also need the proper exchange control approval from the South African Reserve Bank before money is taken in or out of the country.
So to wrap everything up, there are a few taxes to consider when purchasing a property, as well as taxes to consider when receiving rental income. By using structures like trust and companies, you can reduce the effect of these taxes. I recommend working with professionals, specifically chartered accountants, that can help you set up these type of structures. Stay tuned for more financial education.